This section will compare and contrast advantages and disadvantages of ETFs. Exchange-traded funds offer a low-cost convenience. This is most commonly in the form of exposure to entire economic sectors and classes of assets, because it is much easier to keep track and make a few ETF transactions rather than follow and attend to significantly more individual stocks and assets. For example, getting more exposure to the healthcare sector can take the form of buying a bunch of healthcare stocks, which entails keeping track of all those individual healthcare stocks and making all those individual transactions to buy and or sell the stocks. And in the case of assets outside the stock market, such as real estate and bonds, it will again be more convenient just to buy one or two ETFs instead of looking to buy a bunch of bonds, and even more difficult for some people to access real estate. However, this convenience comes at a small fee in terms of management and maintenance costs. Even though ETFs are quite passive, most of the managing work revolves around trying to reflect the price of the assets represented by the ETF. There are still costs associated with the management and maintenance of the ETF. Such fees are very minimal and in most cases don't amount to anything significant. However, they are something to consider. They won't get anywhere near the level of mutual fund fees or actively managed funds. However, the small fee of an ETF is still something to consider. Information about ETF fees is relatively easy to find. It will commonly be listed alongside the other basic information about the ETF, such as what comprises the ETF. Risk is generally reduced compared to individual stocks or assets. Since an ETF is a representation of a collective, they spread out the risk over an average. For example, an ETF representing the technology sector will generally have lower risk compared to owning individual technology stocks. The reasoning for this is that it is much more likely an individual stock or even a couple of stocks can undergo a major drop, as opposed to an entire ETF, which can be composed of dozens or even hundreds of stocks. This can be compared to the analogy that it is much more likely an individual student or even a couple of students will fail an exam as opposed to the entire class. Generally, ETFs also have lower volatility because unlike stocks, they do not have quarterly reports and corporate announcements that often have a dramatic impact on the price of individual stocks. And as a bonus, just like stocks, most large and major ETFs also offer dividends and option contracts. Such ETFs are often highly liquid with very high trading volume. This means millions or even tens of millions of units for these ETFs can be traded daily, which results in buy and sell orders getting filled at more favorable prices faster, perhaps even more so than major stocks, simply due to the high amount of buying and selling taking place with major ETFs. But keep in mind, ETFs are not magic. They can still drop significantly, especially during major market downturns, because while they present lower volatility potential, they are not foolproof or foolproof. They can often lead to a dangerous mindset when traders and investors feel a false sense of security due to owning ETFs as opposed to individual stocks. As well, ETFs also tend to produce quote-unquote average results, which means that they will not significantly outperform the market, because they are a representation for the average of their given sector or asset. That means an ETF will always lag behind the potential for an individual stock or even couple of stocks which have greater potential to outperform the average return of the stock market, which is more closely approximated by the average of an ETF. Once again, you can use the analogy of students to help you. It is much more likely an individual student or even a few students can score 90 or even 100% on an exam compared to an entire class doing so. Since ETFs represent groups of stocks or groups of assets, there will always be more individual stocks and individual assets to choose from. For example, you can find ETFs that represent the retail sector. However, there will always be more retail stocks than retail ETFs. That means a more precise selection can be made among individual stocks as opposed to a few ETFs that represent a group of retail stocks. Now, given those advantages and disadvantages for ETFs, there are certain rationales for using and not using ETFs. Firstly, it is difficult to beat the average return of the stock market over a long period of time, so for the vast majority, it is much easier to be the average, which can commonly take the form of one or a few ETFs that represent the overall stock market, as opposed to trying to manage and pick a bunch of stocks that will outperform the market over the long term. Conversely, it is important to note that the stock market is dynamic and performance of stocks varies over time. That means overall results can vary depending on how and when capital is allocated. This highlights the effect of being in the appropriate sectors at the right price and time, whether it be for ETFs and or stocks. And lastly, good results and bad results are defined by individual ability, objectives, and risk tolerance, which essentially means that an individual trader or investor will see results as good or bad depending on their capabilities and the balance between their profit objectives and their risk tolerance.